Hi, I'm Dan Danford, and this is another episode of Money Made Easy for dadsdivorce.com. Another question from a viewer of the website. I guess you could call me an aggressive investor. I have probably around 90% of my money in stock mutual funds, but I'm becoming concerned that I haven't put more in bonds and cash. Supposedly, the rule of thumb is to limit your stock percentage to 110 less your age, but I feel like I will be giving up some potential gains. What would you suggest? Well, forget rules of thumb. Rules of thumb were created in a different world. They basically hail back to the years when people retired at age 62 and died at age 65. Okay? And many retirement rules we hear today actually go back to that time, and they don't make much sense in the world today. Now, I would agree with you. If you've got almost 95% of your money in stock funds, that's very aggressive. But what you didn't tell me is how old you are and what your time horizon is for that money. Let's just pretend for a second that you're 40 years old. Okay? That means that you have 25 years until retirement and possibly another 30 years in retirement. We're talking a 55-year time horizon. I think almost anyone would tell you with a 55-year time horizon that having a lot of stocks in the portfolio makes sense. Now, you're absolutely right that you could cut back on the stocks and that would reduce some of the risk and the volatility. On the other hand, it would also give up returns, which may be very important to you. In fact, many people today are actually less aggressively invested than they need to be. I mean, if you look at the numbers and you say, okay, this is how much I've got today, and this is how much I'm going to need in retirement, and this is how long I'm going to live in retirement, many of the safer options, bank certificates, treasury bonds, bond funds, any of those kinds of things, simply won't grow to enough money to provide for your needs in the long run. It's far more typical for me to see people who have less stocks rather than people who have more stocks. And most of the people who have more stocks probably have a risk tolerance that allows them to do that. Okay, so your situation, I don't think, is all that dire. Now, I'm not saying that you should have all your money in stocks because you haven't given me enough information to tell you that. Generally speaking, I think when it comes to retirement, cash flow is more important than investment returns. So if you were nearing retirement and you had 95% of your money in stock mutual funds, my question to you would be, well, how much cash do you need out of those funds over the next couple of years? And if you said, well, I need to have $20,000 or $40,000, whatever that number is, then I'd say that portion ought to be moved to bonds or money market funds or something safe. That way, as you need the money, you can pull it out of those safe types of investments and you don't have to worry about whether the stock market is up or down. Generally speaking, the stock market has provided superior returns anytime the time horizon is 5 years or longer. Now, that isn't absolute. I mean, there have been some 5 and 10-year periods of time when that hasn't been the case. But the odds are in your favor at 5 or 10 years if you own a lot of stocks in your portfolio. That tends to keep up with inflation and create real investment returns. So based on the information you've given me so far, I can't tell you whether you have too much in stocks or too little in stocks. What I can tell you is if you will be needing some of this money in the next, say, 3 years or 5 years, then it might make sense to move that portion of the money into something that's less volatile than stocks. To give you a more absolute answer would require that I know more about your circumstances. I hope that gives you some guidelines and some things to think about. Just keep tracking us here on Money Made Easy, and we'll try to update you as time goes forward. That's another episode this week. Thank you so much for joining us at dadsdivorce.com. We'll see you again. Thank you.